Good morning. Today is Friday, September 9th, 2022. I hope you're doing well. We are going to be talking a little bit about what the consumer's doing right now. We have some data on credit card spending for the month of August. We'll talk a little bit about some software companies that actually reported some good earnings for the first time in quite some time. And then we'll close by looking at what health insurance is going to be doing next year. But we're going to start off with markets because last couple of days, markets actually posted decent results. Strong rally a couple of days ago, and it followed through despite some volatility intraday yesterday. And of course, the news overseas, and it was on light volume. So I don't know how much we should be reading into this on a light volume, holiday shortened week, people out of the office, but nevertheless, I think that it's something that is worth noting. And today it looks like we're going to be following through on that too, with interest rates down. And it seems that there is at least a bounce going over in Europe. And I think that that's working to the benefit of US stocks right now. Right now, the correlation between the euro and the British pound and the yen with US stocks is actually very high. So if the US dollar weakens and the euro strengthens and the British pound strengthens, that tends to be good for US stocks. Essentially, what that means is people are becoming more confident in Europe, therefore people are becoming more confident, therefore US stocks are going up. So that's the causal relationship right now. And Tom, I'm not sure what you think is the driving force of this. Obviously, interest rates coming off just a little bit today, but still relatively elevated. What are your thoughts on this? Do you think we're pricing in a lower CPI print for Tuesday?
I think so. It would not surprise me if we're going to see a significant drop off, at least on the top line. I think that, we're continuing to see a lot of those really high flyers come down, no pun intended, but travel is one for sure. But I think the core inflation is probably going to tick up. But I think that eventually we're going to reach an equilibrium there, which is that the inflation number is going to be pretty close on the top line as well as the core. I think, we were in this period of hyperinflation in 5 or 6 areas that really was driving it. And now I think we're going to be in more of a micro inflation across the entire suite of things that are calculated in CPI. So that's kind of my expectation. There was a great interview with Jeffrey Gundlach. I would encourage people to read it. It's pretty approachable for people who aren't, digging into interest rates every day. But he was basically saying, the bond market is indicating peak rates, and that it's disagreeing with a lot of economists in the sense that, people are worried that this is going to roll out of control. We're just going to continue to see higher and higher rates for a sustained period. It's basically saying that that's not what the bond market's indicating, and this might be peak rates. And so we've been very aggressive in buying things this week. We're already starting to see it tick down a little bit. And I think that if we see a lower CPI print, we'll probably see quite a bit of come down on rates in the following week. That's the expectation I have right now. And so in terms of my playbook for today and really as much as I can get done before Tuesday is to look to buy long bonds, look to buy muni bonds. We started buying a few mortgages for a handful of clients who needed exposure to taxable bonds. Because for the first time, even when rates were much higher on mortgages earlier in the summer, we weren't seeing the yields really flow through the actual market. And yesterday we felt comfortable at some levels to buy some very nice mortgages with, serious coupons on them, 5.5%, 6%, which is something I haven't seen on the available for purchase on the mortgage back side in, really probably since 2013 or 2014.
Yeah, I think I think that's worth noting in a portfolio. Obviously, you're not going to roll all the eggs into that one basket. You want to average into it just like you would a stock. But at the same time, for once, we're getting the first time in quite some time. In fact, the highest yields on mortgages since 2008. There might be some opportunities there. And it certainly can raise the overall yield of the portfolio and the overall income that portfolio is throwing off. Shifting gears a little bit to consumer spending, we have some data out of Bank of America. They track really daily card spending, but we're going to be talking about the monthly card spending because it smooths it out a little bit more. Right now, over the last couple of months, we've talked about a stabilization, and really that's just us looking at the daily information on card spending. But now we have the monthly data, and I think it's interesting to note because if you look at the month-over-month spend, there was definitely a decline in gasoline spend in July and August. But connected to that, we did see a reacceleration in furniture. In fact, furniture was up on a month-over-month basis for the first time since April and had the largest boost to revenue since monthly sales since January 2022. If you look at clothing, it was the first increase since April. Lodging as well was the largest since February, where we were rebounding after the weak January from that when we saw the shutdown. So people are spending again, and they're spending a little bit more, which is good news for a lot of these companies. A lot of these companies, as we mentioned yesterday, are seeing some stabilization in sales, and really nothing has changed since they reported in July and to some extent in mid-August. And I think that's good news for these companies in the short term. The negative here, though, of course, is that the longer the consumer continues to spend, the more pricing power that businesses will have, and therefore the more inflation that can go into the economy. Tom, did anything stand out for you on this report out of Bank of America, something to take note of or investment implications?
I would think the one thing that really jumped out is there was a little tick up in clothing. I mean, apparel has been the thorn in the side of the consumer all year. I mean, nobody was buying clothes, and then really this is the first time we've seen an uptick in quite some time on the clothing front. So, read through there, perhaps maybe a little bit of strength in Target. We saw Nordstrom get popped for 25% when they reported earnings. A lot of those higher level aspirational clothing buys really went away once inflation kicked in. Potentially Nike. So that's sort of a read through. If that trend continues to be slightly positive, I think that maybe we've hit a backstop on some of those stocks. But that, like, of all the data, a lot of it was kind of in line. Airlines not moving so much, gas down, but the clothing ticking up, I thought was kind of an interesting data point that might get swept under the rug.
And a little bit more on leisure spending. And leisure spending was up 1.7% month over month. So a lot of those services, people are saying, okay, the price is the price. I'm used to the price now. I'm going to go out to a restaurant. I'm going to buy a plane ticket. And this is the same thing that we heard from the airlines as well. So again, I think that you might see a reacceleration in the coming months on some of these prices that you're seeing on the service side. So that'll be a fair watching going forward. On the software side, we did get earnings results from DocuSign and Zscaler. Zscaler provides authentication services similar to Okta or Duo if you happen to use those services. DocuSign, of course, does all the document signage, and DocuSign has really struggled because what happened was during 2020, their sales force went all remote, number one, and number two, they didn't really have to sell. Most of it was just dealing with inbound leads, which makes it really easy and makes it an awesome job if you're a salesman for DocuSign. The problem is when you have to start selling again, you have to relearn that skill. And a lot of these people had been coasting for some time. And then as soon as they had to start selling again, the sales just dropped. CEO was fired. So they're going through a transition right now. And this was the first quarter out of the last four where DocuSign actually really saw some underlying momentum. They actually raised guidance for the year. They are focusing on getting a new CEO. They're focusing on hitting their margin target. And overall, I thought it was a pretty good report. They still expect to have overall revenue up in the high teens this year. So that's good news. And I think they've kind of stemmed the outflow and stemmed the difficulties with employees. So that's good news for DocuSign. And then Zscaler did mention there was some weakness in their markets, but that a lot of their customers are looking at authentication and security as a strategic priority. So they said there was more deal scrutiny at the end of the quarter. So what does that mean? That means that rather than getting a sign off from the vice president of information technology, you're actually going to the CIO, or maybe you're going to go into the CEO in order to get that approval for that spending on your new authentication platform. But they nevertheless reported very good guidance on both billings and earnings per share. So they think that they can control a lot of that themselves. And their stock is up 14%. DocuSign is up 17% pre-market. Finally, we'll talk a little bit about health insurance premiums, which are moving higher in the ACA marketplace, the Affordable Care Act marketplace. They're looking at increases of about 10%. That might be softened by subsidies. The employer health premiums are going to be up 6.5% to 7%. And employers may be able to reduce that cost somewhat by having higher deductibles, raising copays. But it looks like the top line movement is going to be 6.5% to 7% because they're seeing higher costs with both labor and supplies. They're seeing higher healthcare utilization, or at least they're concerned about higher healthcare utilization. And they're going to have to cover some costs previously picked up by the government, like for COVID vaccine. So, Tom, as you look at the healthcare piece, I don't think we've talked about healthcare all that much, and for good reason. I mean, you've actually seen that healthcare inflation has actually been below overall inflation for the last couple of years, which has been good, but it seems like it's going to be rearing its ugly head again. So I'm curious what your thoughts are on that, how it impacts economics, and also how it impacts the headline inflation data going forward.
I mean, I think it's definitely not going to help. I look back to when I first started working. I think my first job working on the bond desk, I think I paid like $28 per paycheck for health insurance for myself, and it's definitely not that now. So I think this is a trend that's going to continue. I think that we had a little bit of a pause there where people were avoiding going to the doctor at all for fear of either getting COVID or, being, flooding the hospital systems, which was a narrative that obviously we all were very familiar with at the time. So I think that, it's been below average. I think we're probably, like everything else, going to see a couple of years of above average rise in costs there. And it's not ideal. But I mean, this is the way of the world. The question is, the Inflation Protection Act, there were, pieces in there that potentially bring down drug costs, et cetera, et cetera. Does that stuff play through in the way that, we've seen NextEra really dominate, with the environmental piece of that? Is that going to flow through? It's one of those things where every 3 years we get some landmark piece of legislation about prescription drug costs, healthcare costs, and it doesn't really even seem to be a drop in the bucket. So my expectation is it's going to continue to rise and probably be accelerating over the next couple of years as people kind of get back to business as usual. So I guess we'll see how it goes, but hopefully, I think, just like we talked about earlier in the call, other stuff's going to be coming down. And so I think we're going to reach this equilibrium where, there aren't going to be 10 things that are up 40% a year, but there are going to be a lot of things that are up more than the average for a while. So, I think we'll see a lower inflation print next week, and I think we'll continue to see it come down. But the question is, what's the real hard, bottom? What's the floor on it? Everyone's talking about 2% inflation in 2 years.
Getting down to 4 to 5 seems reasonable.
Yeah,
but then getting from 4 to 5 to 2 seems that'll take a lot of heavy lifting, and that's what the Fed is keen to do.
Yeah,
which means that things might cinch just a little bit more.
Well, it's interesting. Like, again, I really would encourage everybody to look up the most recent Jeffrey Gundlach interview, because he was saying that he's of the opinion that if we think that reasonably the Fed is going to raise interest rates aggressively and then cut them next year, why would they just not stop now? And the idea is that rather than try and blow inflation up and have it drop from 8% to 2% as quickly as possible, why not say, hey, we're at a pretty reasonable level here. We're starting to get traction. We're going to slowly glide down over the next 2 or 3 years. And as a result, we're not going to just destroy the economy. His example was, why would I say, hey, I'm going to gain 100 pounds by Christmas so that I can lose 100 pounds and be in shape for Easter, which I think is a fair point. And because of the delayed effect of a lot of these hikes, it is possible that, think about how terrible the predictions have been in terms of inflation and everything, GDP, you name it, where the Fed has been off. His assertion is that if they overshoot it and go too hard on the front end, that we're actually going to end up in a deflationary period where we're going to have a very, very serious recession coming through, which I think, message received, I think it's an interesting way of looking at it. But his assertion also is that Jay Powell has had so many policy errors over the last couple of years. He said, hey, I'm going to attack this as aggressively as possible. The off ramp for him would be, hey, we're just going to raise a quarter point, for a while. slowly ride this thing down, not be super concerned with 6 or 5% inflation, but we're moving in the right direction, as opposed to we're going to stamp out this fire. And in doing so, we're going to blow up the economy. We're going to blow up the jobs market. We're going to get 8% unemployment, and really kick this thing down to 2%. But he also said the reason they would do that is because they want to get back in a position where they can do massive quantitative easing again, which is another fair point. So it's interesting to see the motivation. Someone who's, universally considered an expert in bonds, Jeffrey Gundlach, saying basically there's another way to skin this cat. It doesn't have to be this way, but the Fed has essentially said this is the way we're going to do it. So,
yeah. All right. On that note, we got a big game this weekend. Tennessee favored by, I think, 6.5 over Pitt. Who are you taking?
I think Tennessee wins. I don't know if we cover.
Yeah, I'd take the points.
Yeah,
but
I'd say take the over. If you're going to make a bet, take the over. Our defense is not so great.
Interesting. So there you have it. On that note, have a great day. Have a great weekend, and we'll be here on Monday.